the question on everyone's head is like, okay, I've got all these options. What should I invest in? The shares and ETF. So we have Roger and Jess. And for the property side, we've got Munzurul and Rich Harvey.
So why is it property? It's a tangible asset. It's an asset that we can touch it, we can feel it, we can control it. It has leverage behind it. So we can borrow up to 90%. You ask us as the doctors, it's got no LMI, nothing to be paid after 90%.
When we say that property is a tangible asset, of course it is. We can see it, you can touch it, you can lick the walls if you so fees. But that doesn't necessarily mean that it is a superior investment. I think it is really important to remember that when you buy shares, you are literally becoming a shareholder, a part owner in a business.
Why would you buy shares and live in an ocean of uncertainty where you have no control? Like with property, you have full control. You can decide whether you paint it, whether you upgrade it. With shares, you're at the vagaries of fear and greed in the market.
For more modern investors seeking flexibility, efficiency, and long-term wealth creation, shares are the superior choice.
Welcome back from liquidity, and we are now running the a little
Debate between equities and properties. So it's we've gone through a number of the different sort of investment strategies and asset classes from shares, property. We haven't covered the full extent of it, but I think the question on everyone's head is like, okay, I've got all these options. What should I invest in, and why should I invest in this over another? And I gotta say, before we actually get started, there is no right or wrong answer, but I'm gonna get both sides of the.
There's more of my answers.
All right, so representing the shares in BTF side, I've got Munzurul Khan. I'm gonna give that to you. You're gonna switch it up on
Yeah, please.
No, I'm not that mean. So on the shares and ETF side, we have Roger and Jess. We got Omer, and for the property side, we got Munzurul and Rich Harvey. So for those that don't know, Munzurul is a long-time supporter that invested for doctors. He's the chair of KHI Partner and an accountant extraordinaire. You might have seen some of the Ask Accountant sort of podcast sessions we did at the very, very early stages of our engagement. So welcome, Munzurul. All right. Now, the format for this is going to be quite casual. So we're going to have 5 minutes each, and we're going to go Roger, then Munzurul, then Jess, then Rich. Is that all right? And then afterwards, we get to ask questions and have some rapid fire questions. All right. Now I'm gonna be the timer, and at 4 minutes and 30 seconds, I'll press the buzzer. And once we get 5 minutes, I'm gonna start slamming on the buzzer. All right, I say bell. Okay. Now, Roger. Hi.
Yeah, I mean. Okay, quickly. Who invests in shares? Who likes shares? Who's got property? Direct property? Not your home, investment property. Yeah. Well, I got 5 minutes. Okay, not yet. Oh. So like, I'm gonna read it because I'm well prepared, so I'm just gonna read it.
You're always so well prepared, Roger.
Just tell me when to go. All right, go. Okay, investing is a strategic decision that shapes financial futures. Most shares in direct property have their merits. Shares offer superior flexibility, diversification, liquidity, and long-term potential growth. In today's dynamic economic environment, shares stand out as the more adaptable and efficient investment vehicle. Now, there are 7 points. Liquidity and accessibility. Shares are highly liquid. Investors can buy or sell shares almost instantly through online platforms, allow a rapid response to market changes or personal financial needs. In contrast, property is illiquid, often takes months to sell, and incurs significant transaction costs, agent fees, amazing, legal costs, and stamp duty, your advocate. Example, investors needing emergency funds can't sell part of their share portfolio within minutes. A property investor may be forced to sell their entire asset, often at a discount, and wait weeks or months for settlement. And he can't sell off a toilet. He needs some needs of cash. Diversification and risk management. Shares allow investors to diversify across industries, geographies, and asset classes, reducing exposure to any single risk. Property investors are typically concentrated in one location or market, making them vulnerable to local downturns, zoning changes, natural disasters, and economic shifts. And for example, a diversified share portfolio might include tech, healthcare, energy stocks across Australia, US, and Europe. A property investor in Sydney is exposed to local housing market fluctuations. Number 3, sorry for the sniffing. Low entry costs and greater flexibility. Investing in shares requires far less capital than property, with fractional investing in ETF, individuals can start with as little as $100. Property demands large upfront cost deposits, stamp duty, legal fees, often exceeding $100,000. Flexibility. Shares can be sold up or down easily. Investors can adjust their exposure monthly or even daily. Property is binary. You either own it or you don't. Passive income, tax efficiencies. Shares offer dividends which can be reinvested or taken as income. In Australia, franking credits make dividends tax efficient. Property income is often offset by maintenance costs, vacancies, and management costs. Tax advantages, capital gains or shares can be managed more flexibly. With more flexibility, investors can sell in tranches to manage tax liabilities. After 12 months, you can, that one, yep. Property sales trigger large capital gain events and may incur additional taxes like land tax. Performance and historical returns. Over the longer term, shares have outperformed property in many developed markets. The ASX 200 has delivered average annual returns of around 8 to 10%, including dividends. Property, while stable, often yields lower net returns after costs. For example, a $100,000 investment in shares reinvested over 20 years could grow over to $500,000. The same property might yield $300,000 after costs and taxes. Innovation and a global exposure. Shares give access to cutting-edge industries, AI, biotech, clean energy, and global giants like Tesla, Apple, Amazon. Property is inherently local and slow to evolve. For an example, investors in NVIDIA, which is Jonathan Payne's darling stock, will see CSL benefit from global trends in semiconductors and healthcare. As property investors are tied to local rental markets and infrastructure. And in conclusion, while property offers tangible assets and perceived stability, shares provide unmatched liquidity, diversification, scalability, and access to global growth. For more modern investors seeking flexibility, efficiency, and long-term wealth creation, shares are the superior choice.
Oh, you're done?
Yeah.
Oh, okay. Roger, that sounds like he got that from ChatGPT.
So still right.
Yeah, still correct. Absolutely correct. There's nothing wrong with it. There's nothing wrong with it.
You're next.
We'll bring Munzurul to the stage. All right, Munzurul, you're 5 minutes.
Hold on, just before I start, how long was it for Roger?
4 minutes and 21 seconds.
I get that 39 seconds in addition to 5 minutes. So it was 5 minutes each. All right, I'm going to start with an example, and I'm going to end with an example. Yeah, the example that I'm going to start with LNL. So LNL, you gave us an example saying that your property investor, the cost point property that he or she bought about 20 years ago, and that property was being got for $200,000, and it's being sold at 1.6. I'm using your example. So I sat down, I did a math, and I said, how much was that as a return? And I went back and I sort of looked through the return and I said, depending on how you do. So you're over that period of time. This is that if you do not take any of the transaction cost, that is, if you just purely take that 200,000, it had about 80% return over that period of time. And if you check over the transaction cost, reduced it back, it goes up to 20%. So that's first example. So why is it property? Yeah. Number one, it's a tangible asset. It's an asset that we can touch it, we can feel it, we can control it. It has leverage behind it. So we can borrow up to 90%. You guys, as the doctors, you've got no LMI, nothing to be paid up to 90%. Roger spoke about the land tax. In the commercial property, there is no land tax. The tenant pays the land tax. Yeah. Now, the property has higher stability. The property over a period of time, because of the compounding return and the leverage, has the higher level of the growth. We look into the tax benefit, Roger. You don't have depreciation in shares and the managed funds and ETF. We do have the depreciation. And depreciation is the one which gives us that added layer of the benefit as such. We spoke about the property side of it. You've got manufacturing growth and you've got development growth as well. Manufacturing growth is a property that we can add away, build a granny flat. We can subdivide, create a land behind it. We can create a battle axe land. We can just sell away that battle of lands. That control that we have in terms of the investment side of it, in the shares and the management, you've got someone who's managing it all the way into US and UK, and you've got absolutely no control. Property has got a behavioral advantage, and the definition of the behavioral advantage is that great Australian dream, right? So even if the market sort of drops, we don't sell it. We hold on to it. We wait for the market to increase over a period of time, right? We spoke about the liquidity. Liquidity, there was many solutions behind the liquidity. You can draw down the loan, you can have line of credit, you can have the obstacle. Why do we need to confine ourselves all the way just to purely in terms of buying properties and selling it? We speak about the transaction cost. Many of those transaction costs hardly over 5% as at today's value of some of those transaction costs, yeah? And many of those transaction costs, it gets capitalized over a period of time. So when you add away all of those, there is a reason why it is the great Australian dream, because it does work. Now, if we look into the other side of the share side, but share, number one, is that one argues that it's volatile, right? It goes up, it's down, and we all know that various level of the global crisis that we went through. You look into the share side of it, it depends on the timing. You gotta get that timing right. You got to get the real timing right. And if we were all to know exactly what that timing is, and then we would make it, right? You've got that speculation risk that you sort of follow through. So that's with the properties, the share side of it. Then we look through in terms of the tax side of it, tax and the structural benefits side of it, right? You don't have the depreciation, you don't have the adaptability. We look into the ETF side of it. ETF, we speak about the diversification, and I strongly argue that it's over diversification. What is the diversification, right? So you're buying about $100 of shares, if you're buying about 50 or 1,000 of shares, is that how much is the compounding return on that smaller percentage? So I'm going to end with one other example, if I may. So Roger, in your presentation, you gave us a presentation of 2025 Vanguard index chart. And you sort of started saying that it's saying $10,000. And the $10,000, you gave a whole bunch of different scenario, and your best case scenario was about 214,000 return. Pretty good. Yeah? Very good. Better period of 30 years. Brilliant result. 240,000. Love it. Now, my clients, my doctor clients, what they would do is that they would be using that 10,000. They would use that as a deposit, as in 10%, and they would purchase a property for 100,000. Now, I'm going to use the statistics in your favor to help out. Property prices on average, it doubles every 7 to 10 years. Yeah, let's just assume that it doubles 10 years. It's in your favor. So my client, who's sort of starting with 10 grand, buying $100,000 property, in 10 years' time, well, that grows into 200. In 20 years' time, that grows into 400. And in 30 years' time, that grows into 800,000. 800,000 against 240. Why would I go with shares? Thank you. Yeah.
He's wrong.
With a point of order, you can leverage shifts here, right? Okay, let's switch. And now, who's your Jess?
It's been about 20 years since I was on my school debate team. I remember it being much more fun. You guys have come like very prepared and organized. And I just remember I used to, take digs at the people, but it seems we're not doing that. With thanks to Roger and/or ChatGPT, who has also provided some pre-scripted answers on what you might say and what my rebuttal might be. Thank you, Munzurul, for giving us an okay reason, or sure, that's why you shouldn't invest in property. And I do concede that everyone needs somewhere to live. But what people we're here to do today is to invest our money and to look at how we can grow our wealth. And our home, albeit that it may grow, we shouldn't necessarily see it as an asset unless you intend on leveraging it, which has cash flow concerns, or selling it and downsizing it, which many people don't want to do. So I'm going to go through Roger's / ChatGPT's rebuttals. Well, just in time, my friend. And talk about why actually shares, managed funds, or ETFs may be an appropriate or better solution for your wealth needs over property. We must start with the elephant in the room that I don't think we've spent enough time talking about, and we did talk about the not selling the toilet or the bathroom, but we need diversification. What I see often, so often, is that people double down on one asset class, and that is property. And you are so wedded to not only that as an asset class, but often you buy multiple properties, or people buy multiple properties in the same region, in the same suburb, dare I say the same town. You are way, way over concentrated in property as a sector, potentially, and in microclimates, which we need to just call out. Property doesn't always go up. In fact, there was some research that came out from, I think, Cotality a couple of months ago, that in the last 10 years, 1 in 4 apartments in, I think, 4 different LGAs or government areas lost money. Over a decade, they lost money. So we have this psyche in Australia that all property goes up. No matter where you buy, no matter what you buy, property goes up. And we concentrate, or we double down on property. And yet what we are seeing is 4 LGAs, 1 in 4 of those apartments over a 10-year period, Munzurul, thank you, did not grow in value. So I'll go back to the points that have been written so nicely to me. I think it's also really important that when we talk about property, we must see the reality that when we buy property, we are often wildly emotional. Whether we want to be or not, we often go in and we look at it through our filter, our lens, and not like we do when we're assessing shares, managed funds, or ETFs, because there is that distance. And instead, we filter and we make investment decisions on property with our heart, not often with our head, which I accept is why we have buyer's agents, and you should always use one. When we say that property is a tangible asset, of course it is. We can see it, you can touch it, you can lick the walls if you so please. But that doesn't necessarily mean that it is a secured investment. I think it is really important to remember that when you buy shares, you are literally becoming a shareholder, a part owner in a business. If you wanted to go and touch the head office, I don't know if you want to lick the walls of the head office, thinking where our cap shares are, but you potentially could, depending on whether security guards were around or not. But it is really important that you understand the liquidity issues that come up with property. We cannot overstate that in a time where you may need some level of liquidity in your portfolio. To be able to get that means that you're likely to have to fire sale. As Roger said, you are not only selling the property for less than potentially fair market value, you are waiting a long time to be able to transact on that. And if any of you have sold property, it is a long and expensive journey. So that is a huge, huge differentiator, which you must take into consideration. Property markets do crash. Let's also just remember that. This is my point 2 for ChatGPT, by the way. Think of 2008. If any of you remember the global financial crisis, we did see interest rate hikes. We saw property markets, particularly in places like Western Australia, if I remember correctly, tank. And so it is important to remember that just like shares and managed funds and ETFs, properties don't always go up. And what I like to think about is with the share market, we can see every day it bobbing around and what it's going to do. We don't have that level of visibility or transparency with property. I think if we had a little chart out the front of everyone's property to say what it was worth today, you would see there's actually a lot more volatility than you might expect. You've talked about leverage, and leverage is a huge, does that mean I have 30 seconds? Yeah. Oh God. A huge way that you can build wealth. Absolutely. But do not forget, to B's point, you can borrow to buy shares, managed funds, or ETFs. Do not think that the only way that you can borrow to build wealth is through property. That's what these friends would like to tell you. But unfortunately, that is not the truth. Remember with rental income that there are risks. If your tenant doesn't pay, if you can't get your tenant out, it's like me on Monday after some storms in Melbourne, you get told that your roof needs repairing. That is a heck of a lot of costs that unfortunately we do need to bake in. If you would like to hear my 17 other ChatGPT points, I will be here if you choose.
Oh, super, yes. And now to close it off.
Sorry, I didn't get one.
Lucky last. I actually don't have any notes. It's all just going to come out of my head. But a couple of key things. Why would you buy shares and live in an ocean of uncertainty where you have no control? Like with property, as Munzurul has already calmly described, you have full control with the property. You can decide whether you paint it, whether you upgrade it, you have full control. With shares, you're at the vagaries of fear and greed in the market. All the rest of the market is going to influence your return. I don't want to have that sort of pressure on me, right? I don't want to be subject to someone else's fear and greed out there. And one of the charts that really scared me today was our second speaker just after morning tea. Well, do you see the GFC drop? 50.3% drop. It's never happened in property, right? And if we look at the trajectory of where property is going to go in this country, we are having a massive supply crunch. I'm actually producing a report. I'm interviewing some of the top economists, all the bank economists, all the best property commentators at the moment. I'm putting together a very detailed report called the supply crunch. So for me, property is the bedrock of wealth. It is the ability to leverage. You guys are so lucky. For every dollar, you can leverage it 9 times. Can you do that in shares? 9 times? I don't believe so, right? Who would want to do a margin call at 9 times leverage, right? So no, thank you. Not saying there's no place for shares. I'm just saying, I'm going to ask you this question. Do you want an average return or do you want a fantastic return? If you want a fantastic return, go property, right? And this is the thing. I got into property because I interviewed 10 financial planners. No disrespect to financial planners, but I interviewed 10 when I was probably around 30 years old. And I was trying to find someone like you guys are in this room to guide me, to help me to make a decision. I couldn't find any planner that was independent. They're all trying to sell me off the plan crap and put me into just managed funds they're going to get massive commissions from. I know the industry's been cleaned up, thank goodness. But I just couldn't find anyone. So I thought it's ridiculous. So that's why I started my business, because I wanted to give people independent advice. Anyway, an aside point, but it's that tangible asset. It's about leverage. It's about control. It's also about just how you can really grow a portfolio. Like, yes, you can, the volatility, yeah, look, shares don't always go up. They go up and down, and they go down a long way, right? Going down the escalator. But property has a much greater stability. If you need to reduce the rent, you can drop it $20, you get a 10, right? But with shares, it can be much, much more volatile. The other thing is the tax benefits. Thank goodness that, we've got some great accountants in the room, because you can leverage so well and maximize tax deduction, especially when you're on a higher income. You don't want to be paying Mr. Albanese any more than you need to, right? You can spend it a lot better than he can, I'm sure. So you want to maximize your return, and you can do that so well with property. So it's the leverage, it's the ability to build a bedrock of wealth, intergenerational wealth, and pass that on to your family, to your kids, help them get into the market. So for that reason, I nominate property the winner. Thank you.
Excellent.
Well ahead of time, Rich. So
I'm ahead of time. That's why I didn't need to go to the full 5 minutes.
I've got other points if you want to say them.
No, I don't need you to.
Alrighty. Now, we're gonna open it up to the floor. So, but before we do that, a round of applause for the mates. All right. Now, we still got 15 minutes. So we're gonna ask some questions, and we also judge them by the quality of the answers to the questions. What's up, baby?
Hi, Munzurul. I've got a question for you. Did you factor in the interest that we would be paying to pay off that mortgage?
Brilliant question. And the answer is yes. And what I did is that in one hand, I've taken the interest, and on the other hand, I've taken the rental return behind it, as well as the tax benefit. And particularly because Roger's example was about 30 years ago, the average return, if we assume in these suppos, it was about 8%. And if we look back, the interest rate at that stage was about 5.95. So I think that on average, that it would be quite cash flow positive, and that you've got the tax benefit. So the answer is yes.
So even after deducting the interest, even then we would go up to 800,000?
Yes. So see, there was a concept called Rule of 72, yeah? And Roger can sort of confirm that concept of Rule of 72. And what that Rule of 72 means is that, let's say your coffee, as an example, today, it sort of cost you, let's say, about $3, yeah? So if you divide, divide 72. If you divide 72 by 3, that means the same coffee will be costing you in 24 years, you would pick up, yeah? So on that concept of Rule of 72 is that if we say property prices double every 10 years, means our compounding return is 7.2%. And if we say property double with 7 years, our compounding return is 10%, right? So instead of utilize the lower level of the return, and even by utilizing the lower level of the return over 10 years, if it doubles, on the example, simple example, right? 100,000 goes into 200, 200,000 goes into 400, and 400,000 goes into 800. Now, to be fair, and that's sort of communicated as part of the debate, right? But to be fair, of course, you got to take the inflation behind it. And to be fair, of course, you're going to take a whole bunch of transaction costs along the way that you got to take. And also, to be fair, is that you still have to take the selling cost behind it. And to be fair, you got to take the purchase cost behind it as well, right? So it's not all 100 goes up all the way to 800, but the point is being made is that 200,000 and 800,000 seems to be awfully gap.
All right, that's such an accountant answer. We got another question here. One question only.
Sorry, it's this question is personal, and if any one of you don't want to answer it, that's perfectly fine. Those in favor of shares, do they own any properties? And those in favor of properties, do you guys own any shares? And if yes, then what percentage of your total? Yeah.
It's a really good question. And I always am pretty transparent that I actually have a natural bias towards property. So I was delighted to, on the other side. And that is, coming back to this morning's conversation, that's a values thing for me. So I have to be really careful not to push that onto people, because I grew up with no money. And so for me, security and independence is really important. And so for me to have property was something that I felt was really important for me as a female in my 30s who was not going to inherit a huge amount of money. But that doesn't mean it's right for everyone, which is why I like debates like this. And, I was just saying before, and I really wish I wasn't going to muck this up, but, in the wise words of Old El Paso, how does it go? Okay, no, that's us. Why can't we have both? Why can't we have both? So to answer your question, yes, I have property and I have assets that are, I don't have many single stocks in terms of shares. I do have some. They're more of like my old, they're a legacy as part of my portfolio. I have, in terms of where as a percentage, it's probably, the Melbourne market hasn't done great. That's Rich.
On the way up, that's
yeah, still hang on to it. Hold on. It's nothing nicer than seeing your property, the market go down. I'm like, I'm in for the long haul, but then being told your roof's in trouble. I'm like, great, laugh that for me. It is probably 60-40 split, 60 equity and property for me at this time. Not including superannuation, not including the investment bonds that I have for my nieces for when they turn 25.
Yeah, and you get 2 comments, I suppose, with the full transparency. Number one is that I don't have any shares. I've got a whole bunch of properties, and 1999 is when I bought my very first property. 2001, I purchased my second property, and since 2001, I purchased property every year. Yeah. The second comment which I normally say is that my standing, it really is not share at properties. Yeah, and my true standing is that there is a time and place for both. And yes, diversification is important. And if I look into my super fund as an example, I've got some shares, right? And part of the reason I personally have purchased shares is that I feel that I do not understand enough. So it's not really the share. It's not really the share. It's about understanding. But on personal perspective is that it's all about property from my end.
Can I add that onto you don't own publicly listed shares or privately held shares?
That's various businesses. I have a home. I don't have any investment property, and it's all shares. And it is ETFs because I don't want to pick an individual stock. I want to pick an ETF that is in a particular sector, so I still have a lot more control. I can get into AI, I can get into biotech, I can get into blockchain, all that type of stuff, as well as the staples like industrials and all those types of things, the banks, all that sort of stuff. So I find a lot more diversified, I get a lot more rich. Who would have known that Netflix would have been so valuable? It's just a little crappy little startup. There's so many of those. I'm still relating here. In Australia, there's between 20 and 40, is it 20 or 40, 20 to 60 or 20 to 40,000 properties on the market at any one time. And there's 2,000 shares.
Actually around 400 to 500,000 properties on the market.
There you go. So I'd run, and then there's 2,000 shares. Well, it's GBT top thing. Shares, 2,000 shares on the Australian stock market. So I'd rather get it right at 1 out of 2,000 than 1 out of $400,000. So shares is for me. Look, I do buy property. I'm a financial advisor who does like property because it has its place, and it's great for its appreciation and things like that. But again, when clients are wanting to buy property, I want to invest in property. So yeah, Ash and I, we can do all the modelling, all that type of stuff around it. We don't care if it's got green roof and peaked doors. We don't care as long as the numbers are right. But then I panic and say, well, you've got to talk to a buyer's only, because I get concerned. If you don't know enough, you'll stuff it up. And that's what my concern is. If you don't want to go through the portfolio, which we know a lot about through these direct ETFs and all that type of stuff and global portfolios, and if you want direct property, I get worried unless we're using buyer's agent, because you can stuff it up. Because we can get the numbers right, the numbers that you have on paper. He can get the properties that are right, that actually deliver those numbers. So I'm an advocate for both. But I prefer shares because I like to have the ability to get into stuff that people, like I've been at golf, well, most clients have been in golf for the last 4 years. And it's outperformed most golf fellows in Australia because they've had gold in there and things like that. You can't as little alpha portfolios at a house.
I'll be really quick. To answer your question, I'm probably about 15% shares, all in my super fund, and 85% in property, naturally, because I've got extreme knowledge in that area and I fully understand it. I'm very different to most people because I live and breathe it 24/7 and I can manufacture a lot of equity. But I've been, I look back at my portfolio and I've more than doubled it in the last 10 years, probably 150% increase on value. It's quite amazing. So, for the long haul, it works super well. But the answer is you got to have both and diversify, set up offset accounts, and then you can have liquidity to live on.
Thanks.
My question, as somebody who's contemplating between the two, and like all of you, you do have a bit of both, even if you're passionate about one or the other. I find that people who speak property do minimize the risks to a great extent, as opposed to, the share price, you can look at the price up and down every day. But property is very emotional. And people who are pro-property tend to, talk more about the upsides and not about the downsides. Now, typical example just from today, say you have $1 million in shares and you have $1 billion in property. If you have $1 million in property as a liability, what about your insurance costs, your PPD? All of those costs have to go up. And nobody ever says that if you have a property portfolio of $4 million, and you are the person who's insuring it, that is sky high compared to somebody who has $1 billion in shares. That's now, I have probably less because I don't have that liability and I have the ability to sell it and it's very liquid.
You should have been up here in this.
Well, I think the answer to your question is, you're talking about expenses like insurance and maintenance. You just got to have a buffer. Like if you're getting a 5% gross yield, probably it's to allow 1% for expenses. It's probably more than generous for that. Like I've got properties in Queensland and you've got to make sure you've got cyclone insurance. Never had to claim on it. But just make sure you got it. But it is what it is. It's the cost of doing business.
I think one of the things which I do, your question is a very good question, right? It is a good question. It's a valid question. Huh? So it's not so much shares and properties, right? One needs to really look forward to, say, 5 years' time. And this is where we go back just to your presentation right at the beginning. You're going to go forward to 5 years' time. You got to go forward to 10 years' time and 15 years' time. And you almost have to visualize that where do you see yourself within that period of time? And you work backward from there. Yeah. So from 15 years, you go back to 10 years, you go back to 5 years, you go back as at now. And you would find it's that when you do this is that you have a combination of all of the above. And the other comment which I say is that when you purchase a particular property, you take all the cost into account. So you assume that it is 105% borrowing, even if it is coming in 10% as a cash contribution, coming in some other equity as such, you do the maths saying that, well, if the property is being rented for, say, 50 weeks, as opposed to 52 weeks. Yes, I would have high level and some level in this, the repairs and maintenance on an ongoing basis. How much is it cash flowed out? What is the negative cash flow? Then you got to ask the question to yourself, set aside the tax. There will be half of it as a tax benefit, but we set that aside, right? You do that maths and you sort of say, well, this property will cost me about 15,000 for argument's sake. Then you ask the question that, am I comfortable with that 15,000? And if the answer is no, then perhaps property is not for us at this stage, or perhaps this particular property is not for us. And if the answer is yes, we make an informed decision.
Munzurul, that's a good question. I was just going to raise that point. I was going to say property makes you money while you sleep. But by the way, if you can't handle the fluctuations on the share market or the property market, you really need to just take a breather and get the right headspace. See, for me, I love making money while I sleep. I know I'm going to hold the property for 10, 20 years. It's going to be amazing. And I just budget for that. The other thing what I'd make is that buying a property is excellent financial discipline. I'm trying to teach my boys who are just buying their first properties that buying a property, it's always the vacuum theory, right? If you've got money sitting in an account, you want to spend it on something. Spend it on property and it'll look after you as you get older.
Can I make 2 points just to that? I don't know if it was a question, more of a really well thought out comment. Firstly, I just want to say Rich did not buy the properties that I have. Just if SEM, I got confused because I said thanks, Rich. It was more just a dig at him being on the team property. Just wanted to clarify that. But what I think is really important to say, and it's sort of following on your point, is today I've learned a lot. Hands up if you've learned a new concept today and you didn't know before you walked in. Great. Hands up if you saw a slide today that you didn't understand fully. Yeah. And this is why this morning I said to you, you're going to be thrown so many different things and it can get so, is making fun of us. It gets, what I'm worried about, just being really transparent, because this is always here for a bit of fun because it always depends on your situation. But taking into consideration the fact that you have a lot of new information thrown at you today, some of which you still may be trying to figure out. I also didn't have my glasses on. So if you saw me staring at the graphs, I was just trying to be able to read the slides because there was a lot of technical information in there. What I don't think any of us want is for you to be so overwhelmed by all of these different options and all of the different things that you've heard about from lots of great people today that you go and do nothing. Because doing nothing is still a decision. And I can pretty much guarantee that we're all on the same team where we say doing nothing is probably not the right decision. So whilst I want you to make an educated decision and go and speak to professionals where you need to, it is important to say that there is not one size that fits all, which can frustrate people. But please don't take all of the great insights that you've learned today, using your beautiful, no doubt very smart technical minds, get overwhelmed with analysis paralysis and stay stalled, because you will stay out of the market, and market in every asset class is likely to continue to race ahead, and you will be frustrated that you didn't just go. And if you've ever read about, remorse, people often are regretful about the decisions that they did make and didn't make. And we always think, what if I'd have done that thing instead? How different would life be? It is not helpful, I don't think, but it is just really important to know most units we often do that anyway. So stop second guessing. If you've done all of the right things, take the next step, whatever that be.
You're rolling for like the bear.
Sorry.
You're very diplomatic. So we have the last question.
Hi, thank you so much for the debate. I hope you're still friends. Really very part. My question is probably around emerging technologies, AI, analytics. Obviously, as a health professional, we've seen how it's performing and it's sort of transforming in front of my very eyes. And it has sort of shifted my decision making when it comes to how I want to practice and how patients would benefit from it and which way to go. So I'm just quite curious about what are the currently emerging, or existing AI or any technology analytics that you find are exciting and then beneficial and promising, and then maybe that could swing it towards ETF versus property.
There's sort of two bits of that. There's two bits of that. The boss, the CEO of NVIDIA, he did this presentation of John Main said it in one of his reports. It was an hour and a half, so I was glued to it. And he was talking about, obviously, the development of AI and how industry is investing in the US and all that type of stuff in the rest of the world. The one point that I really resonated with me when he was talking about, AI is still a tool. It's just like Word's a tool, PowerPoint's a tool, all that. They're just tools. You still got to work. You still got to do the work, but they're just tools. AI is now going to be a worker for you. It's not a tool. It's actually going to do the work for you. So it's when there's the exponential change in technology, we don't know where it's going to go. What's stuck with me is like, it's going to be a tool. How can that apply to what I do, or maybe what you guys do? Now it's a worker, not just a tool. It's a worker. How does that work? And I'm trying to still figure that out. How can I turn AI into doing the work for me rather than using it as a tool?
I suppose there's a couple of things comes into mind, right? We still need a house to live, one. And but then when we look into the AI, in my mind, I sort of say that things that I can control are the things that I concentrate, yeah? And the things that I suppose can't control, I stay conscious with it. I stay adaptable to it. I stay resourceable to it. But we get over paranoid in terms of things that we can't control. So what can I control? Yeah, I can sort of control with sort of an understanding that there will be a change of demography, so to speak, let's say. And what does that mean in terms of change of demography? Yeah. So if you look into the IT and AI and sort of people working from home quite a bit and also the efficiency that it's generating and that you've got all those AI agents as such, there has to be a demographic impact to it. And that demographic impact is the one that I would take that a lot more into account. So I'll give you as an example, Richard, that I'll probably argue that on that basis, if we look into some other places such as the New South Wales, Central Coast as an example, beautiful places, lovely places, say, water views. And so there was a huge price gap. And the reason why that price gap is simply because it's so far away from your Sydney CBD for one to sort of drive. But with the technology in advance is that I take that into account, saying that, well, maybe we're not driving back to the city every other day. We're only doing it 2 days. And that means that Central Coast property, which is a water view, much lesser price is a lot more attractive to me as it is to be in the price. So if I concentrate on that Central Coast as an example, my growth potential, one argues, would be higher. Mighty.
Can I just make a point about AI? AI enhances our process of decision making, but it doesn't replace decision making. We use AI extensively in our business with our research, but we have to it's all about the prompt, right? Everyone knows that good prompts give good answers. Good questions delivers good answers. So we use it, for example, if a client comes on, we prepare what's called a suburb profile, a pre-dem report. We can produce them so much faster than we used to with better accuracy now that we can use AI. We can even use AI to help us shortlist properties, both on and off market. When we get briefs, we can set them out so much. There's some really cool tools, but it doesn't replace, I guess, the local knowledge and the nuance. Like, Roger's going to have really good ideas on which stocks because he knows the nuances of the ETF markets. I don't know that stuff, right? I know the nuances of the property market. I know, having been in the industry 30 years, I know the nuances. So AI doesn't know that, but I can guide how it uses research to make better decisions.
I'll add my thoughts, and my answers are quite different to what so I don't know if I've misunderstood your question, but I'm just going for my answer anyway. I think what is really exciting, and it's been huge change and development in the investment landscape, is the ability for everyday people to be able to invest with such a small amount of money, but also to have such a lot of choice in investment markets. And so, there was a time when I started where I would, be holding a check, if any of you remember what they are, and, you couldn't get into a fund unless you had $250,000. That was a huge amount of money and such a high watermark that really did lock a lot of people out. Now we have the ability for you to buy a coffee and round up 50 cents and be able to put it in the markets. So if I've understood your question correctly, which I'm sure I haven't, what I'm really excited about in the development of ETF products over certainly the last couple of decades, but especially over the last decade or so, is we're seeing, yes, all the index-based ETFs, we're seeing diversified index ETFs, so ones that have got lots of index options within them, but we're also seeing some really cool thematic-based ETFs. So the ability for you to be able to double down on robotics or food, or, there's some really interesting ETFs. So if you've got a particular interest like AI or a particular sector that you want to invest in, you don't necessarily need to have all of the money to become like an angel investor or to go into the VC firms, because that might mean you need to be a wholesale investor and you might not have enough money to do that, or it might just be too much risk. So the ability for you to actually be able to access exposure to those sort of industries or sectors that you're interested in through an ETF product makes it low cost generally, a lot more diversified, but also remember you can become an angel investor. I would just caution you to think about concentration risk and make sure you really understand what you're getting into. And, I'm sure Roger would got to say, many people for a long time asked me my thoughts on crypto. People have tended to ask me my thoughts on crypto so much of late. Like anything, especially when it's highly speculative, my general stance would be just put in what you might be willing to lose.
Casino stuff.
Right. Now, thank you everyone for such an engaging session. Now, you have to be fair win. And so we'll do it by applause and cheer. So it's crowdsourced. I don't get to decide anything he says. Now, so we'll start off with the property cap. If you think that they did well and deserve to win. Door here.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.